Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of corporate filings so you don't have to. When a company is bleeding money, you might expect fireworks, but sometimes the most interesting stories are in the silences. Today we are diving into Ironstone Properties Inc.'s quarterly report for the period ending June 30, 2025. It's a look at their financial health and what's really going on behind the scenes. First off, let's get a handle on the scale of the company. As of the end of June 2025, they had about 3.4 million shares of common stock outstanding. This gives us a basic idea of how big their ownership pie is. Now let's jump into the numbers themselves, starting with the balance sheet. This is like a snapshot of what the company owns and what it owes at a specific point in time. For total assets as of June 30, 2025, Ironstone reported a little over $3.1 million. This isn't a massive sum for a publicly traded company, and it seems to be mostly tied up in non-marketable securities. However, when we look at their liabilities, they owe over $3.5 million. This immediately tells us something important. The company is currently owing more than it owns. And when you subtract liabilities from assets, you get stockholders' equity, which for Ironstone Properties is a negative number over $400,000. This basically means if they were to sell everything they own today, they wouldn't have enough to pay off all their debts. This is a classic sign of a company in financial distress. Now let's look at their cash position. As of June 30, 2025, they only had about $12,000 in cash. This is an incredibly small amount for a company of this nature and raises serious questions about their ability to meet immediate financial obligations. Where is their money tied up then? A whopping $3.1 million is in non-marketable securities. These are investments in companies that aren't publicly traded. Think of them as private company stakes. This also means their value is hard to pin down and can be quite volatile. Looking at liabilities, we see they have around $348,000 in line of credit borrowings and a staggering $3.1 million in notes payable and accrued interest. This is the bulk of their debt and clearly the main reason why their liabilities outstrip their assets. Now, let's see how they performed in terms of making profit. This is the statement of comprehensive income. Just for the 3 months ending June 30, 2025, Ironstone reported a net operating loss of nearly $82,000. And for the 6-month period ending June 30, 2025, the net operating loss widened to over $157,000. This shows a trend of losing money from their core operations. A huge chunk of their expenses comes from interest. For just the 3 months, they paid over $57,000 in interest. Their operating expenses, including things like compensation, professional fees, and administrative costs, were about $24,000 for the quarter. When you put it all together, their comprehensive loss for the quarter was also nearly $82,000. This tells us that even accounting for other income and expenses, the company is still firmly in the red. And when we look at per share, a loss of about 3 cents per share for the quarter. The statement of cash flows is crucial because it shows us where the company is actually getting its money from and where its cash is going. Making a profit on paper is one thing, but having actual cash is another. For the 6 months ending June 30, 2025, they started with a net comprehensive loss of almost $158,000. When you adjust for changes in things like payables, they actually used over $11,000 in cash just to run their operations. This is a negative sign as it means their day-to-day business is burning through cash. On the financing side, they received around $33,000 from stock options. This is a common way for companies to raise a little bit of cash. The net effect for the 6-month period is a decrease in cash of about $13,000. This means their cash pile shrunk over this period. They started the period with about $26,000 and ended with just under $13,000. This is a very precarious cash situation. Let's talk about those non-marketable securities in more detail. These are valued using level 3 inputs. What does that mean? It signifies that the valuation relies heavily on unobservable inputs, meaning estimates and judgments, rather than readily available market prices. The bulk of these are private company common stocks valued at nearly $3 million and about $200,000 in private company preferred stock. The fact that these are in level 3 category highlights the uncertainty in their valuation. The valuation for the preferred stock is based on the purchase price from way back in June 2022, and it's still being valued based on that cost. For the private company common stock, the valuation is tied to a valuation range of $2.25 billion derived from something called Virtua valuation analysis. This is a very subjective way to value assets. One of their significant private investments is in Tangami Inc. Back in March 2012, they invested $1 million in preferred stock, which later converted to common stock. By the end of 2023, this investment was valued at over $3 million that year, and markdown loss of over $1.2 million that year. Interestingly, in January 2024, they sold some of their own stock in a tender offer. This generated some cash, but also resulted in a realized gain of about $11,000 and a return of capital. They also received a dividend of over $75,000 from Tangami in May 2024, which helped boost their income that period. Another investment is in Akimoto Inc. They initially invested in preferred stock, which converted to common stock. They've had options in Akimoto too. However, the value of these investments seems to have plummeted. By the end of 2022, Akimoto's stock price had dropped dramatically, and Ironstone sold off most of its holdings to cover operating expenses. As of June 2024, they held only 1,000 shares valued at a minimal amount, and their Akimoto stock options now have zero value. Their investment in Boy Health Inc. also tells a story. After an initial investment in March 2021, they saw market conditions cause a markdown in 2022. However, in 2024, they marked down their investment significantly by over $77,000 due to a management buyout at a much lower share price. They also invested in Aristotle Inc., purchasing preferred shares in June 2022. The valuation has remained unchanged for 2023 and the first half of 2025, indicating no significant activity or changes in its perceived value. Now, let's touch on related party transactions. These are dealings with individuals or entities connected to the company's management or major shareholders. In March 2021, William Humbrecht, who is the CEO, loaned the company $300,000. A significant event occurred on May 27, 2022, when William Humbrecht converted over $824,000 of debt and accrued interest into company stock. This helped reduce the company's debt, but also diluted existing shareholders in a way. Also in June 2022, Harold Bradley, a board member, bought 121,000 shares of common stock from the company. The company also has stock option plans. In April 2021, they granted additional options with an exercise price based on a weighted average price and an illiquidity discount. These options vest over 3 years and are amortized over that period. For the first 6 months of 2025, they recorded $3,000 in stock-based compensation expense related to these options. Additionally, in February 2024, 50,000 stock options were granted to the Chief Financial Officer. Now in item 4, we see a very candid admission from management. They state that their disclosure controls and procedures were not effective. This is a serious statement, meaning they don't have robust enough systems to ensure accurate and timely reporting of all material information. Part of this ineffectiveness stems from the fact that the company does not have an independent audit committee, although they are exploring forming one. An independent audit committee is a key component of good corporate governance. Another major issue highlighted is the limited number of employees, which leads to a lack of segregation of duties in accounting and financial reporting. This means fewer people are checking each other's work, increasing the risk of errors or even fraud. In the risk factor section, they clearly state their main assets are these non-marketable securities and that there's no guarantee a market will continue to exist for them. This emphasizes the speculative nature of their investments. Scroll now for my take on Ironstone Properties Inc. What we're seeing here is a company that's in a very precarious financial position. Their liabilities far exceed their assets, meaning they are technically insolvent. They have very little cash on hand and a significant portion of their assets are tied up in private investments that are difficult to value and sell. The ongoing operating losses and high interest expenses are a drain on their finances. The lack of an independent audit committee and segregation of duties in their financial reporting are significant red flags. These point to potential weaknesses in corporate governance and internal controls, which could exacerbate their already difficult situation. The company's strategy seems to be relying on the future success and liquidity of their private investments. However, with the current economic climate and the inherent risks of private markets, this is a very uncertain path to profitability. The fact that their cash balance is so low suggests they are constantly in need of funding to stay afloat. They might be looking at selling more equity or converting debt, which could dilute existing shareholders or come with unfavorable terms. In terms of strengths, it's hard to identify any immediate operational strengths given the financial picture. Their primary hope lies in a successful exit or liquidity event from their non-marketable investments at a valuation that can help them get back on solid ground. But the current market conditions and the company's financial health make this a long shot. The biggest risks are their ongoing losses, their lack of cash, and the speculative nature of their investments. The potential for further dilution or unfavorable financing terms is also a significant concern for any existing shareholders. Ultimately, Ironstone Properties Inc. appears to be a company struggling to generate revenue and manage its expenses effectively. Their reliance on illiquid assets and the significant debt load paints a picture of high financial risk, without a clear path to generating consistent income or a substantial improvement in their investment portfolio. It's difficult to see a strong future for the company. What do you all think about Ironstone Properties' current financial state and their future prospects? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give it a thumbs up and subscribe for more deep dives into corporate filings. Don't forget to join our Discord community linked in the description for more conversations and analysis. Thanks for watching, and we'll see you in the next one.